Oil just posted its biggest weekly decline in over 18 months, and most traders are absolutely terrified. But here's what they're not seeing. The ship attack in the Strait of Hormuz just created a geopolitical bid that's completely disconnected from the fundamentals. There is one danger zone and one hidden opportunity in Brent crude right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, whether you're a sniper, an active trader, or an aggressor looking for the big home run. Here's my session bias. On the daily time frame, Brent is in a strong sell trend. That's undeniable. But we are now trading at extreme oversold levels with a major geopolitical catalyst that's been completely underpriced. So my verdict: this is a fading opportunity within a broader downtrend. Write this number down: 72.54. If we break below 72.54 today with a daily close, the entire structure resets, and we are looking at 71.20 or even 69.10 in the coming sessions. But if we hold 72.54 and see any kind of bullish confirmation, the snapback rally could be violent. The herd is overwhelmingly positioned on the short side right now. Retail sentiment data shows oil bears at their most crowded level since the 2020 negative pricing debacle. When everyone's on one side of the trade, that's exactly when a market likes to humble them. And remember, the ship attack in the Strait of Hormuz isn't a supply shock yet, but it's a reminder that geopolitical risk premiums can reappear in an instant. Let's start with the weekly chart, because that's where the real story lives. We have seen a brutal 15% decline from the April highs, and the 200-week moving average is sitting at 83.48, acting like a massive brick wall overhead. We are currently trading almost $8 below that, which tells you how overextended this move has become. The RSI on the weekly is at 28.76. That's deep into oversold territory. Now, oversold doesn't mean a reversal is imminent, but it does mean the probability of a snapback rally increases with every additional down day. Now look at the daily chart. This is where things get interesting. We have the MACD showing negative 6.45, and that's a significant bearish reading. But here's what most traders miss. The MACD histogram is starting to flatten out after reaching extreme negative levels. This is the early seed of bullish divergence. We are seeing price making lower lows while momentum indicators are flattening or starting to curl higher. On the daily, we've got the 5-period moving average at 76.25 and the 200-day at 83.48, both well above current prices, confirming the strong bearish trend. But the ADX reading of 52.84 tells us this downtrend is mature and potentially exhausted. When ADX is above 50, it typically indicates trend strength, but it also often signals that we are in the late stages of that trend. Now the 4-hour chart, this is where I'm really focusing my attention. We've broken below the 4H demand zone around $75, and the 4H pivot point at 74.65 is acting as near-term resistance. The RSI on the 4H has dropped to 28.76. That's lower than the daily reading, which is actually bullish divergence in the making. The CCI at negative 102.3 confirms we are extremely oversold. Let me show you something most retail traders completely miss. Look at the relationship between Brent and the Goldman Sachs Commodity Index. Oil is underperforming the broader commodity complex by a significant margin, which is unusual given the geopolitical backdrop. When you see that kind of divergence, it often precedes a mean reversion trade. The 1-hour chart, that's where the immediate battle is happening. We are seeing the 1H trend flip to buy, and that's our first sign that the selling pressure is starting to ease. We've made a higher low on the 1H compared to yesterday's low, and the MACD on the 1H is showing the first positive crossover in over a week. That's a micro-signal, but it's the first crack in the bearish armor. Here's what most traders miss when analyzing oil. The price action in Brent is not moving in isolation. We are seeing a direct correlation between oil and the US dollar, but that correlation is breaking down. The dollar's been firm, yet oil is finding a bid at 72.54. When correlations break down, it's usually a sign that something deeper is happening. In this case, The geopolitical bid from the Hormuz attack. Now let's connect this directly to what happened in the last 24 hours. The ship attack in the Strait of Hormuz changed everything because it reintroduced the geopolitical risk premium that had been completely stripped out of oil prices over the past month. The market had been pricing in a scenario where the Middle East conflict would remain contained, and the ship attack shattered that assumption. Here's the fundamental truth that most analysts aren't saying. The wrangling over tolls and the structure of the attack suggests this may be a warning shot rather than the beginning of a broader escalation. But the market doesn't care about intentions, it cares about probabilities. The risk that the strait becomes a flashpoint just increased significantly, and that has to be priced in. At the same time, we have the OPEC Plus production decision hanging over the market. The current narrative is that OPEC Plus is ready to bring supply back online, but here's the wrinkle. If they do that amid geopolitical tensions, they risk destabilizing the market further. The cartel is in a difficult position where they want to maintain market share but also want to avoid a collapse in prices. The yield spread between the 2-year and 10-year Treasury is also feeding into this. Real yields have been moving higher, which should be a headwind for oil as a non-yielding asset. But the geopolitical bid is overriding that fundamental driver right now. Now let me give you the 1 to 2 week directional lean. I believe the path of least resistance over the next 1 to 2 weeks is actually to the upside, but with a very clear caveat: this is a counter-trend rally within a broader downtrend. I expect a move back toward the 75 to 77 range before sellers re-enter. The key event that invalidates this entire view: a clear statement from OPEC Plus committing to a significant supply increase. If we get that, 72.54 is going to break, and we'll see a rapid move towards 60-9. Do you think oil rallies back to 78 this week? Comment yes or no. I'm tracking consensus on this one. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to give you 3 exact trade plans with specific entries, stops, and targets. Strategy 1, the sniper, conservative. This is for traders who want to wait for the absolute highest probability setup. Here's the exact trigger condition. I want to see a 4H candle close above 75.98. That's the first resistance level, and a break above it would confirm that the selling pressure is exhausted and we are seeing a genuine reversal attempt. The stop loss for this strategy is placed below the 4H demand zone at 72.54. Your risk per contract is approximately $3.44, which is significant, so position size accordingly. But the risk-reward is actually quite attractive because we are targeting a move to the 200-period moving average on the 4H, which is sitting around 78. Target 1 is 75.98, which is actually your entry trigger level. Wait, let me correct that. The entry is above 75.98, so target 1 would be 78.09. Which is our second resistance level. That gives you approximately a $2.11 move from entry. Target 2 is 79.42, which gives you a $3.44 move. The risk-reward on this is approximately 1 to 1 on the first target and 1 to 1.6 on the second. What voids this setup entirely? If we get a daily close below 72.54, the entire structure breaks down. The conservative play is invalidated until we see price reclaim that level. Strategy 1, the sniper, conservative, entry, 75.98, 4H candle close above, stop loss, 72.54 take profit 1, 78.09 take profit 2, 79.42 risk, reward, 1:1.6 invalidation, void if daily close below 72.54. Strategy 2, the active trader, standard. This is the mean reversion play that I believe offers the best probability for today's session. Here's the entry condition. On a pullback to the 1H moving average cluster, I'm watching the 1H pivot point at 74.65. I want to see a rejection wick or a bullish engulfing candle at that level. This is a classic mean reversion setup where we are buying a pullback within a potential reversal scenario. The stop placement for this strategy is below the recent swing low on the 1H chart at 73.80. That gives you approximately 85 cents of risk. The reason I'm placing the stop here is because a break below 73.80 would indicate that the selling pressure hasn't exhausted and we are likely to retest the 72.54 low. Target 1 is the 4H supply zone at 75.98. That's our first resistance level and gives you approximately $1.33 of profit, a 1.5 to 1 risk-reward ratio. Target 2 is the 4H 50 period moving average at 78.09, which gives you a $3.44 profit, a 4 to 1 risk-reward ratio. Once target 1 is hit, I want to move the stop to break even and let the trade run toward target 2. If price breaks through 75.98 with conviction, we are likely to see an acceleration towards 78. Type your Brent price prediction for tomorrow in the comments now. Let's see who's aligned on this one. Strategy 2. The active trader, standard, entry, 74.65, pullback to 1H pivot plus bullish reversal candle, stop loss, 73.80 take profit 1, 75.98 take profit 2, 78.09 risk, reward, 1:1.5R to 1:4R invalidation, void if 1H candle closes below 73.80. Strategy 3. The aggressor, high risk. This is for those who can handle serious volatility and want to chase momentum on the small time frame extremes. Here's the play. If we see a break below 72.54 with a 1H candle close, I'm looking for a short entry with a tight stop above the previous 1H high at 73.20. This is a counter-trend continuation play, and I want to be crystal clear about the risk here. The stop is at 73.20, which gives you approximately 66 cents of risk. That's a relatively tight stop, but it needs to be tight because the downside potential is significant. Target 1 is the 4H demand zone at 71.21. That gives you approximately $1.33 of profit, a 2 to 1 risk-reward ratio. Target 2 is the weekly support at 69.10, which is the pre-Iran war low from earlier this year. That would give you a $3.44 profit, a 5 to 1 risk-reward ratio. Here's the explicit warning. This is for those who can lose small and manage risk aggressively. If you're not comfortable with the idea of being stopped out on a volatile spike, stay away from this strategy. And I need to emphasize, the market is extremely oversold, which means the probability of a reversal is increasing, making this high-risk play less favorable than the other two. The aggressor, high-risk, entry, 72.50, 1H candle close below 72.54, stop loss, 73.20 take profit 1, 71.21 take profit 2, 69.10 risk, reward. 1:2R to 1:5R invalidation, void if 1H candle closes above 73.20. Warning. Oversold market increases reversal risk. Never risk more than 1 to 2% per trade on any of these setups. And I mean it. No moving stops wider, no adding to losing positions. The oil market is going to have a 70-cent spike in any direction on just a tweet about the Strait of Hormuz. No positions through the next inventory report. Stops are non-negotiable. This is how you survive to trade the next big move. The traders who get wiped out in oil are the ones who get caught on the wrong side of a geopolitical headline with too much size. Don't be that trader. Let me summarize the single most critical level for the next session. 72.54. That's the line in the sand. As long as we hold above that, I'm looking for a snapback rally towards 75.98 and eventually 78. But a daily close below 72.54 and all bets are off. We are looking at 69.10 next week. The ship attack in the Strait of Hormuz is the wildcard factor that could override all of this technical analysis. If we get any significant escalation, all these levels go out the window and we are in a geopolitical price discovery mode. The market hasn't priced in a full-blown supply disruption yet. That's the risk premium that remains on the table. Tomorrow, I'm watching the US inventory data and any statements from OPEC Plus officials. That's going to be the primary driver of the next significant move if you want the full breakdown on how this oil setup correlates with the S&P 500 gold. Those videos are live now. Tap the end screen, smash like if this gave you a clear trading plan for Brent crude. Subscribe, hit the bell, and I'll see you in the next one. Remember, in this market, The best traders are the ones who wait for confirmation and manage their risk. Stay disciplined, and I'll talk to you soon.